Hello everyone and welcome to the channel. Today we're going to be talking about monthly dividend paying ETFs, because there are a lot of them out there. And a lot of low quality dividend ETFs are trying to lure investors, even though the ETFs they're offering are expensive and don't necessarily have the best fundamentals. So in this video I'm going to help you find quality, high yielding dividend ETFs. So you can see here I've been living off of and investing in dividends for passive income now for about 10 years. And I've gone through most of these dividend ETFs personally and myself. I'll be showing you the tricks and strategies I've been using to find the best dividend ETFs, and also 5 specific dividend ETFs I personally invest in. So let's get started. As a quick crash course, an ETF is a short term for an exchange traded fund. And what this does is it gathers a basket of large stocks, bundles them all together, and then sells them as a single new stock. That way, rather than having to buy hundreds of dividend stocks just to get safety and diversification, this bundle gives you diversification and exposure all at the same time for a pretty low share price. That way, if any one company goes bankrupt and fails, it's likely you won't lose all of your money overnight. The first thing we need to talk about for dividend ETFs is, of course, the yield. Just because a dividend ETF has a high yield doesn't necessarily mean overall you'll make the most money with it. There are other metrics you need to know in order to succeed with dividend investing, especially if you're going to passive dividend invest, which I will explain to you in this video. But to save you time, if I had to buy just one dividend ETF, it would be SPYD. You can see it right there. Now, if you want to learn how I found this and the tricks and strategies you can use to find quality ETFs in general, stick around for the rest of the video. This is the SPYD S&P 500 High Dividend ETF. What this investment does is it ranks all the companies in the S&P 500 by dividend yield, and you can see from these two charts that searching for higher yields does bias the fund, this ETF, to financials companies and energy companies. But at the same time, this is an ETF that maybe is concentrated in financial companies and to a lesser extent energy companies. One upside is that the top 10 positions in this ETF are only 14% of the portfolio, meaning that it's not very top heavy like other dividend ETFs. So all in all, SPYD, what it is essentially a dividend-seeking algorithm. It just trims through the best companies in the US stock market and then finds you the best dividend payers at the highest yields. It bundles them all together, saving you time and research and giving you diversification across many dividend-paying companies at a relatively low price. It's currently trading at around $40 a share, and the dividend yield on this ETF is currently 4.52% according to TD Ameritrade, and with $100,000 invested, you can expect to make about $4,500 a year in dividends. This averages to about $370 a month. That said, this dividend ETF pays you quarterly, or once every 3 months, 4 times a year, meaning that you will be waiting some time in between your dividends. Now, if you really don't like that, if you really don't like waiting so long for your dividends, there is an alternative to this ETF that's very similar, and I will show you that similar ETF, but we'll get back to that later. Now back to SPYD. As you can see down here in Yahoo Finance, the expense ratio for SPYD is 0.07%. And I can tell you upfront, that is in the top tier of expense ratios. If you don't know what an expense ratio is, it's simply the annual fee that the ETF company charges you to maintain the ETF. So ETFs are actually investment products put out by companies like BlackRock and Vanguard. So as you can guess, many of these ETFs are not free, although some are so cheap that they might as well be free. So obviously, the more passive and hands-off and automated an ETF is, the less expensive it will be. I've looked at the research and the average ETF expense ratio is 0.44%, but ideally you should be buying nowhere near 0.44%, because in reality, the worst case for an ETF should be about a 0.2% expense ratio. So let's take an example. Let's say there's an ETF you found, and you wanted to invest $10,000, but you see that it has an expense ratio of 0.07%. So that would be, if you do the math, charging you about $7 per year to maintain your investment in that ETF, which is actually pretty good. $7 on $10,000, that's really low. But you have to wonder, well, what if I invest more money into it? Wouldn't that cost me more? Well, at a $100,000 investment into the SPYD ETF, for example, you would only be charged $70 per year to maintain your investment, and so that the ETF company can maintain the investment product and keep it listed on the stock exchange. Now, you don't have to actually worry about an expense ratio per se. You'll never see a fee, you'll never get charged for it. You'll never actually see that ETF fee be deducted from your account. What happens is this cost of the ETF is automatically reflected in the share price by just slightly lowering the value of any shares you buy in an ETF. And frankly, if you were to get a dedicated in-person financial advisor, that would at least cost you 1% to manage your money, if not more. So with a financial advisor as compared to an ETF, if you invested $10,000 with a financial advisor, that would cost you about $100 a year in fees. And with this ETF, that would only cost you $7 in fees. So there you can see why ETFs are such a powerful investment product. There's just a huge difference. So ETFs have a good place in the stock market and can overall save you some money as long as you learn a little bit about how to invest in these yourself. So back to SPYD once again, you can see this dividend ETF pays you quarterly. So in SPYD's case, that means that once a quarter, it's paying you about $1,100 every 3 months. But if those dividends were paid monthly instead of quarterly, you would be making about $377 a month. I know a lot of people who love monthly dividends, and I do get that. So there actually is a very similar dividend ETF, and that dividend ETF is SPHD, or the Invesco S&P 500 High Dividend, Low Volatility ETF, SPHD. With this ETF, you will be getting monthly dividends, but with this ETF, there is a price you pay for that. As you know, nothing is free. But first things first, we'll be comparing SPYD, which is the quarterly dividend payer, to SPHD, which is the monthly dividend paying ETF. The expense ratio in SPYD is 0.07%, which we remember, SPHD, that expense ratio is 0.3%, and that's actually more than 3 times higher. Now that said, it's not too significant. As you remember, $100,000 invested with SPYD would be costing you about $70 a year in fees, but of course at the same time you'd be waiting longer with that ETF to receive your dividends, which is once a quarter, whereas SPHD holders, they'd be getting their dividends every single month, but on a $100,000 investment, they'd be paying fees of about $300 a year. And if you annualize that over 10 years of consistent buy and holding strategy with these two ETFs, that comes out to about $700 in fees for SPYD and $3,000 in fees for SPHD over 10 years. Composition-wise, SPHD and SPYD share a lot of their top 10 holdings, though I will note SPHD is more reliant on cigarette and oil companies like ExxonMobil and Altria Group, and its top 10 holdings are actually twice as top-heavy as SPYD, coming in, as you can see here, top 10 holdings, the weight is 29%. The plus side is, though, that overall, SPHD is more sector diversified, relying on safer sectors like utilities, as you can see here at 18%, and consumer goods, rather than with SPYD, 41% in financials and 14% in energy. Overall, sector-wise, SPYD is much more concentrated. Now, if you're fine with energy companies like oil companies and others, and also financial companies like banks, then you shouldn't have a problem with this ETF. As for the total return of the ETF SPHD and SPYD, over the last year, across the coronavirus recovery in 2020, the two ETFs have been neck and neck. But overall, SPYD has actually returned more since November of last year, outperforming SPHD during the recovery year, giving you 63% in returns to only 46% with SPHD. Now, across their lifetimes, since 2016, SPYD more often than not has actually outperformed SPHD. And especially if you look at it between 2018 and 2020, SPYD was routinely in the lead. But that's actually not the entire story, because if you look at a bar chart of the actual dividends paid out by SPYD, you can see the distributions are far more volatile, but overall I will admit they have been trending upwards since 2015. SPHD, on the other hand, though, has been far more consistent over a long time period, demonstrating its ability to grow its dividends despite giving them to you monthly rather than quarterly. And I can tell you many dividend investors actually prefer consistency over raw statistical performance and increased volatility. And I mean, after all, if a dividend investor cared the most about performance, they'd be buying S&P 500 ETFs and QQQ and not investing for dividend income. Now, everybody's strategies and goals are different, so you have to think about this one yourself and think about which chart you prefer. Do you prefer raw performance or consistency with SPHD? But there's actually a third position. If you buy both SPYD and SPHD, that way, everything about the two ETFs averages out and kind of meets in the middle between those two ETFs. Your expense ratio would meet in the middle, averaging between your two ETFs, falling to about 0.185% on your expense ratio. Your dividend yield would average out, and now you would receive monthly as well as quarterly dividends. Here's an expected 1 year's worth of income on a $100,000 investment, again from SPYD. If you'll remember, this pays you about $4,500 a year, according to the income estimator program from TD Ameritrade. But now for SPHD, if you were to put $100,000 into this ETF, that would pay you about $3,902 across the entire year, with $325 coming to you in dividends every single month. But here's the question, why not both? What would happen if you split your money between those two ETFs? Now, of course, you can try any mixture you like, but what would happen with half and half invested in SPHD and SPYD, blending these two strategies, monthly dividends, quarterly dividends, high volatility, low volatility? Let's see what happens. You would get about $4,212 returned to you in dividends before taxes, and monthly that comes out to about $351 in dividends. Now, of course, in the quarters ending June, September, December, and March, you would be getting a larger dividend payment, but at the same time too, you'd also be getting monthly dividend income. So obviously the choice of what to do, which one to buy, or if you want to blend them together is up to you. But those are my picks for the 2 overall best US dividend paying ETFs. Now, I don't know about you personally, but I don't like overexposure to just one country. I want to be more of an international investor. So if you want to accomplish that with a dividend ETF, that naturally brings me to my second favorite dividend ETF that I've always paired up with my main dividend ETFs and stocks. And that ETF, of course, as you can see here, is VYMI, or the Vanguard International High Dividend Yield Index Fund ETF. This ETF is good if you don't want all of your investments tied up to just one country's success, in this case, the United States. So as you can see here, it pays you over a 3% dividend, paid quarterly, and the expense ratio is 0.28%, which we all know is a little bit lower than SPHD, but significantly higher than SPYD. But that expense ratio actually makes more sense when you consider that there's more compliance work necessary to maintain an ETF of international and foreign stocks. What this ETF does is it takes a list of all the major dividend-paying stocks in emerging and developing markets outside the United States and ranks them by size and how much they're expected to pay you in dividends over the next year. And after that ranking is made, only the top half of those stocks are selected, giving you in theory the highest quality stocks. With a $100,000 investment in VYMI, you can expect about $2,980 per year in dividends, and that averages to about $248 a month in dividend payments. But of course, as you can see, this is also a quarterly dividend payer, so you'll be receiving your dividend payments 4 times a year. As you can see in terms of its geographic distribution, it is slightly Western biased, but you do get Japan, Hong Kong, and other Asian countries on there. I will tell you one thing, this dividend ETF is definitely not top heavy. The top 10 holdings, which some of you will recognize, Nestle, Toyota, for example, Novartis, the top 10 holdings aren't even 14% of the entire portfolio. Overall though, this ETF is heavy on foreign financial companies, which actually in practice means foreign banks. Though second place I will note is basic materials, which would mean mining companies. Now let's look at performance, because actually how I track the performance of ETFs is something called total return. So this accounts for all the money returned back to you in terms of dividend yield and also share price appreciation. And I think total return is the most important metric, and too many dividend investors only look at dividend yields. For me, it's the big 3. The 3 most important things are dividend yield, tax treatment, and total return. Let's take a look. Zooming out now to 5 years, you can see VYMI was a contender against the S&P 500 until about 2018. But then after that point, it consistently lagged behind. That said though, the S&P 500 contains a lot of growth companies, and you really need to compare apples to apples, right? Because VYMI is not an S&P 500 ETF, it's a dividend ETF. So what that means is you're choosing when you invest in it, you want current income and dividends at the expense of future growth. So you don't buy into a dividend ETF like VYMI to be a growth investor. So let's compare apples to apples. VYMI versus SPHD. Over the last year in 2020, the chart looks like this. Now that's actually for the most part looking better, because you can see VYMI and its total return was actually returning ahead of SPHD over the last year, but only recently the gap is closed. Even still, VYMI is ahead. But now let's take a look at the long-term view. These are the last 5 years comparing VYMI versus SPHD. VYMI was defeating SPHD from about 2016 to 2019. So overall, right now in return, they're actually quite comparable, 50% to 47%. But considering that VMI is giving up on US exposure, the returns are quite comparable. And actually, most of the time, I would rate the advantage with VYMI. More often than not, over the past 5 years, VYMI is defeating SPHD. Now, in terms of the dividends themselves, VYMI's dividends can be a little erratic. I will admit, overall, they've been trending upwards. Now for tax. Now, as a quick crash course, dividends are taxed in 2 ways. Either as a qualified dividend, which is the good kind, or an ordinary dividend, which is the not so good kind. As you can see here, for dividend tax rates in 2021, a qualified dividends tax rate maxes out at 20% when you're earning more than $445,000 a year. This is in the case of a single filer, somebody who's not married. But as you can see here, the vast majority of people receiving qualified dividends will only pay in reality 0 or maybe 15% in taxes on those dividends. The trick is, though, that only certain US companies are eligible to distribute to you qualified dividends. And on top of that, there are some foreign companies that will give you qualified dividends, but for the most part, there's only a few of them. So as you can imagine, most REITs, BDCs, and really exotic ETFs and closed-end funds likely won't pay you a qualified dividend, which is what you ideally want. Now you can see here with ordinary dividends, they're taxed at the same rate as your paycheck. It literally just counts as more income you're getting, so it's the same as the normal federal income tax rate. So here you can see the highest tax bracket is 37%. That's only the case when you're making over $500,000 a year. For the most part, the vast majority of ordinary people will be taxed anywhere around 22% up to probably 32%. That's starting at $40,000 going all the way up to $200,000 a year. That will be the vast majority of ordinary people. Now with that crash course finished, with VMI actually in 2020, you can see 73% of the dividends were qualified dividends, which is really good. And in 2021, as of the end of March, it's actually 93%, which really isn't bad at all. And all in all, I really like VYMI because if you buy it, you're protected if there's ever a downtrend in the United States economy or it goes flat for many years like Japan. It's really great for diversification. It may not be statistically the best dividend ETF. It really opens up your options. Now, speaking of performance and growth stocks, there's one dividend ETF out there that I think is good for newer dividend investors looking to start their investing journey and build up their dividend income for later rather than seeking current income. That dividend you can see right here is VIG, the Vanguard Dividend Appreciation ETF. Currently, you see it pays you about a 1.53% dividend yield, and its expense ratio is actually the lowest on this list. It's just 0.06%. Really is incredible. What this ETF does is it picks stocks that maybe aren't currently the biggest dividend payers right now, and these companies don't exactly have the highest yields, but they have future potential to become stable dividend aristocrats. And all of these companies have a really solid track record of the growth in their share price. So here, for example, you can see companies like Visa, Microsoft. The idea is when you buy this ETF, you capture the growth of high growth stocks, and then later on in your investing career, as you're closer to financial freedom, those dividends will rise and mature as these companies become larger dividend payers in the future. And you can see the appeal if you're starting out as a dividend investor, where you don't necessarily need all of your current income immediately, and you can wait for future dividend growth. So all in all, you sacrifice current dividend yields for explosive future growth. And I can tell you there's just no contest. So here's a graph of the total return, meaning the share price appreciation as well as dividends. And you can see here VIG is blue, SPHD, which is pretty much the standard dividend ETF, is in green. And you can see here VIG has consistently returned more than SPHD since 2016. Especially you can see after 2018, it became no contest between these two dividend ETFs. So if you want dividends and growth at the same time, this is a good dividend ETF. And it's pretty good, I would say, if you're a beginner investor or you just have time on your side. Or maybe you're perfectly happy waiting and you know that as these companies grow and mature, they're going to reward their shareholders with dividends. Now here's the thing. If you think that's all I have to give you, I actually have one final bonus niche strategy ETF. You're not going to be using this dividend ETF all the time, but it can help you in some situations. Now, I know a lot of investors are just holding cash in their brokerages, and when you do that, when you're sitting on so much cash, you're asking to have your dry powder wiped out by inflation. So if you have cash sitting in a brokerage and you're not quite ready to use it yet, but you know you will use it later, you can buy an ETF, as you can see here. You can buy an ETF called VGSH, which is the Vanguard Short-Term Treasury Index Fund ETF. And what this ETF does is, at an almost non-existent expense rate of 0.05%, it buys stable, safe, government-backed, short-term U.S. Treasuries and pays you a monthly distribution yield, as you can see here, of just 0.79%. The price of this dividend ETF is incredibly stable. Generally, you have no anxiety when buying in and out of this ETF just because of how stable the price is. It's like a pseudo cash. So if you have cash waiting to be deployed, what I like to do is put it into VGSH. There's no time limit or anything. You'll get your distributions once a month, and it helps you fight inflation just a little bit if you're sitting on cash. All in all, it's better than nothing. And I can tell you, me personally, I've used this ETF to shield my cash while I've been waiting to make large purchases or when I've been preparing for large private investments in the past. That's all for this video. It's gone on long enough, so I will be brief. I want to thank you all recently. I've gotten so many new subscribers on the channel. I'm actually almost at 1,000 subscribers, which really is incredible. And I noticed that this channel has received a lot of positive response from the dividend investing community, and I want to thank you in particular. My promise to you is I'll treat you right, okay? I promise when I get into the super high tax brackets, I won't leave you guys behind, and I'll continue to make content for you. So thank you for supporting the channel. As always, leave a comment. That's my favorite part of the channel. And if you want to get started investing, I have two links down in the description. One is to M1 Finance, which is good for beginner investors. And then I have a second link for the investing app Webull, which I think is better for intermediate to advanced investors. I'll leave you with a salute, and until we meet again.